dreamer, but my heart's of gold. I had a runaway.
Welcome back. Today we're doing one of those episodes where the headlines look scattered, but the theme is actually pretty clear. The long-term story matters more than the short-term story. We're going to connect a few dots that, at first glance, don't seem related at all. The Fed holding rates steady, mortgage rates still refusing to come down, retirement savings mistakes couples keep making, and then, because life is weird, some fresh longevity stories and even scalp science. But stick with us, because it all comes back to one question: what's quietly changing underneath the surface? And if you're thinking, how do we go from bond yields to a 119-year-old in Costa Rica? That's exactly the point. Markets, personal finance, and health all punish people who only think in the next 24 hours.
Let's start with the Fed week drama. The Federal Reserve kept rates the same. On paper, that should feel like a sigh of relief, right? No hike. No surprise move. But the market didn't celebrate. And here's the weird part for regular people: even without the Fed changing the policy rate, longer-term rates, like mortgages, still edged up. So someone out there is saying, wait, what? They paused, and my mortgage quote got worse?
Here's the basic translation. The Fed can control the short end of interest rates pretty directly, but mortgages are tied more to longer-term bond yields. And after the Fed's comments, traders basically decided the Fed might not need to hike more because the bond market is already tightening financial conditions for them. In other words, the Fed is looking at higher yields out in the market and thinking, hey, the economy is getting pressured already. Traders heard that and went, oh, so the Fed might lean on yields rather than hike. And then what happened? Bonds sold off, yields rose, and mortgage rates ticked up. It sounds backward, but it's a real market reflex. People didn't hear pause as easy money is coming. They heard it as the bond market is going to stay the enforcer. And none of this took a huge policy change. That's the lesson. Mortgage rates can react to messaging, tone, and interpretation, sometimes more than the actual decision itself. Now layer in the economic data. Inflation cooled more than expected. Core PCE was only 0.1% for the month. That's the kind of number you'd think would calm things down. But growth slowed too. GDP came in at 1.5%, which missed forecasts. So the picture is mixed. Inflation looks better, growth looks weaker, and the job market is still tight, but with little hints of softening. Right. Jobless claims stayed low, but continuing claims moved up a bit, people staying unemployed longer. Not a crisis signal, but it's a pay attention signal.
And yet, you could argue none of those numbers were the main driver this week. Bonds cared a lot about energy prices and global tension. Oil and geopolitics moved the mood more than the spreadsheets did. That's such an important point for people trying to time rates. You can watch every inflation print, but then a geopolitical flare-up shows up and suddenly yields move anyway.
So where did that leave mortgage shoppers? Rates stayed stubbornly high, but we didn't see a blow-up week. After the Fed announcement, lenders mostly went sideways or just a touch lower. It's like the market exhaled, but it didn't relax. Which brings us to the bigger vibe: sensitivity. When rates are near long-term highs, the system becomes jumpy. Small shifts in language, small shifts in oil, small shifts in global risk, and suddenly the cost of borrowing moves. And this is where the mortgage industry is dealing with pressures beyond interest rates. Climate risk is not an abstract concept anymore. If extreme weather is shifting where farms can operate, if temperatures are changing where crops thrive, that's not just an agriculture story. That's a property risk story.
Exactly. We're seeing whole industries relocate over time: vineyards, farms, regions that used to be ideal now becoming harder to insure, harder to finance, harder to predict. Lenders and insurers are being forced to update how they think about risk. And at the same time, there's a technology and standards conversation happening inside finance. There was reporting about scrutiny at a major bank over alleged pressure on staff to approve loans for wealthy clients. Proving that underwriting standards are not just a math problem, they're also a culture problem.
When money is expensive, the stakes go up. A loan that looks marginal becomes more dangerous. And any pressure to just make it work gets riskier for everyone involved. Okay, Now let's zoom out even further, because this is where the long-term story really kicks in: housing wealth. There's a projection floating around that grabs people's attention. The national median home price is around $430,000 now, and under multiple scenarios, it could potentially reach $1 million in about 25 years. And when you hear that, you might think that's impossible or that's a bubble. But then you look backward. In 1990, the national median home price was roughly $90,000. Even places that felt pricey then, like San Francisco, had medians around $250,000. So the real lesson isn't that next year will be amazing or terrible. The lesson is compounding. Housing wealth has been compounding for decades, driven by tight supply, demographics, and inflation over long stretches of time. And that brings up something people don't talk about enough: reverse mortgages and aging in place. Because if you're an older homeowner, your biggest financial asset might not be your portfolio. It might be your house. A lot of homeowners approaching retirement aren't dreaming of selling and downsizing. They want to stay put. Aging in place is not a niche trend anymore. It's the plan for millions of people.
So the question becomes, how do you access housing wealth without moving? That's where reverse mortgages, including HECKEMMS and proprietary versions, start showing up in retirement planning. More equity can mean more borrowing capacity, more flexibility for healthcare expenses, home modifications like ramps or safer bathrooms, the ability to get rid of an existing mortgage payment, or even set up a line of credit for later. And what's interesting is, this opportunity doesn't depend on housing sales being hot. If you stay in the home, appreciation and mortgage paydown can still build wealth over time.
But we should say it plainly: reverse mortgages aren't for everyone, and they deserve careful review. Fees, terms, the impact on heirs — this is not a sign here and relax product. The point is bigger. The home is increasingly a retirement asset, whether people planned for that or not. Alright, from housing wealth to a super practical money mistake that's happening in households right now: married couples and 401k matching. This one drives me crazy because it's so fixable. There's analysis highlighted by Boston College economist Jeffrey Sanzenbacher suggesting a lot of couples are leaving employer matching dollars on the table. Not because they're irresponsible, because they're not coordinating. Only about 40% of couples actively coordinate how they contribute, and around 20% leave match money unclaimed. That's not "oops, I forgot to buy a coffee at home." That's potentially thousands of dollars over time.
And it's not even complicated. If one spouse isn't contributing enough to get the full match at their workplace, while the other spouse is maxing out or allocating differently, the household can accidentally miss free money. Let's make it real. Imagine partner A has a job that matches 100% of the first 4% of pay, and partner B has no match. If partner A contributes only 1% because money feels tight, the household is effectively turning down a guaranteed return.
Exactly. The fix is a conversation. Not a dramatic one, just a "hey, what's your match formula? Are we capturing all of it?" conversation. Because communication is probably the cheapest retirement upgrade available. And this links back to our theme. People obsess over daily market moves, but miss structural wins. Capturing the match consistently is like building your own personal compounding machine. Okay, let's lighten it up while still staying on theme: longevity. Because if you live longer, and statistically, many of us will, then retirement planning, housing wealth, and health span become one giant connected system. There's a man in Costa Rica, Jose Flores, reportedly born in 1907, who could challenge the record for the world's oldest living man if his age is officially confirmed. The truly wild part isn't just the number, it's the activity. By reports, he walked about 1 kilometer a day to a senior center well past 110.
And when asked for the secret, the answer wasn't some expensive biohacking stack. It was basically, work hard, have faith, eat healthy. Simple, not easy. And then there's a 111-year-old woman in China sharing a different angle: emotional regulation and routine. She talks about not carrying problems into bed, sleeping early, waking early, and keeping a disciplined schedule with naps.
That sentence, "I never take my troubles to bed," that's a financial lesson too. People lie awake stressing over money, and it feeds bad decisions. Sleep doesn't solve the issue, but it often makes the problem smaller and your thinking clearer. Now, the culture side of longevity is expanding too. There's this growing idea that longevity isn't only about living longer, it's about looking and feeling good while you're doing it. That's where the beauty tech world is sprinting.
We're seeing products that sound like sci-fi, like a scalp-focused serum pop-up in London, and cosmetics claiming a skip-the-filler kind of lift effect for lips. And then there are big conferences like healthspan summits where researchers and entrepreneurs are basically competing over one promise: extend the good years.
Whether you're into that or you roll your eyes at it, it's still telling you something. People are planning for longer lives. Industries are shifting to serve that. And that has financial consequences: longer retirements, more healthcare needs, more demand for adaptable housing. So let's tie this up with a few takeaways you can actually use this week. First, don't assume the Fed holding rates steady means mortgage rates will fall. Mortgage rates are a bond market story, and the bond market reacts to tone, oil, geopolitics, and expectations. Second, if you own a home and you're thinking long-term, remember that housing wealth is bigger than a housing market headline. Over decades, it compounds. And for older homeowners, the question may shift from, should I sell, to how do I stay and fund my life?
Third, if you're married or partnered, do the 401k match check. Not someday. This week. Find out each employer's match formula and make sure the household isn't accidentally leaving money behind.
And fourth, longevity isn't just a feel-good story. If a longer life is even a possibility, it changes the math. It makes health span matter, it makes stress management matter, and it makes financial planning feel less optional. The big thread is patience and structure. Markets will jump around. Headlines will scare you. But the people who win financially and personally are the people who build systems that keep working even when the week gets noisy. That's it for today. If you want, send us your questions, especially if you're wrestling with, should I buy now with these rates? Or how do we coordinate retirement contributions without overcomplicating it? We'll keep it practical.
And next episode, I want to dig deeper into one idea we only touched: what climate risk means for home values and insurance over the next decade. Because that story is quietly becoming a major factor in housing and lending.
Please subscribe at IamHealthyMoney.com and visit us at Q&A with Kim and Ray on YouTube. It would mean so much more than you know. I will continue to bring you fascinating subjects with all the research so you don't have to do it all alone. We will learn together. And then wait until the end of each video for a sneak peek into the next research project. Life has its ups and downs, but you're not alone. From 10 to 110, we're in this together right here, right now. We love ya.
My heart's like an open book for the whole world to read. Sometimes nothing keeps me